The live market quote for Caterpillar stock, trading on the NYSE under the ticker CAT, shows it currently sitting at $553.55, which is a drop of $19.47 or 3.40% in today's intraday session. Seeing a blue-chip industrial titan like Caterpillar shed this much value in a single session immediately raises a few serious questions, especially given the stock's stellar performance leading up to its recent all-time highs. This significant drop is the crucial, unexpected insight we need to focus on, because the immediate market narrative is that this is simply profit-taking after a massive run, or perhaps a general market pullback finally catching up to the heavy equipment leader. However, the reality is more nuanced. The sharp decline comes right on the heels of the company's recent investor day, which, while outlining an impressive long-term vision, appears to have triggered a sell the news reaction as investors digest the subtle but significant shift in growth drivers and near-term macroeconomic caution coming from management and analysts. The market often takes the path of least resistance, and right now, that seems to be a retreat from what many view as a stretched valuation following an incredible run fueled by a surprisingly strong earnings report and the unexpected tailwind from the global data center construction boom, which has little to do with traditional bulldozers and excavators. Most people look at Caterpillar and see the ultimate infrastructure stock, a direct bet on global construction, mining, and oil and gas activity. The common belief, especially over the past year, has been that government infrastructure spending in North America and resilient global demand for commodities would keep the order books full, pushing the stock price to record levels. The stock's massive rally, which has seen it outperform the broader market handily year to date, has been largely priced in based on this straightforward, cyclical boom outlook. But here's the contrarian take that's causing today's dip. A closer look at the actual drivers of recent growth, particularly in the spectacular Q3 2025 report, reveals that the energy and transportation segment, specifically the massive demand for power generation equipment tied to the frantic build-out of AI and cloud data centers, is a substantial and less predictable catalyst. While a win is a win, some institutional investors and analysts are asking whether this specific high-growth, high-multiple driver can sustain the massive premium CAT stock is trading at, especially as the construction industry segment faces headwinds from an uncertain outlook in U.S. non-residential building and an oversupplied equipment market. The expectation was a steady, cyclical climb. The reality is a growth narrative increasingly dependent on a tech-adjacent segment, coupled with cautious commentary on core construction, which creates a tension that leads to volatile days like today. Today's trading volume is elevated, confirming that this price movement is not just a minor fluctuation. There is serious institutional repositioning happening. We've seen reports of some key company insiders, including the executive chairman and the chief accounting officer, selling substantial amounts of shares in the days leading up to and following the investor day. While insider sales can happen for personal reasons, a string of multi-million-dollar sales at elevated prices adds a layer of anxiety and gives cover for other large funds to de-risk their positions. The institutional ownership data is fascinating, showing a massive number of institutional buyers over the past year, with total inflows in the billions, yet the recent 13F filings show some minor position reductions, suggesting a shift from accumulation to profit-taking or selective trimming among the thousands of institutional owners. This selling pressure, combined with the general risk-off sentiment hitting some industrial stocks today, is why we are seeing a drop of over 3%. It's a classic example of a stock needing a breather after a phenomenal surge, but the specifics of why are all tied up in this subtle growth narrative reevaluation. Looking back at the Q3 2025 earnings, which were reported just a few weeks ago, the company genuinely crushed analyst expectations on both the top and bottom lines. Sales and revenues were a record $17.6 billion, a strong 10% increase year over year, driven almost entirely by higher sales volume across all three primary segments: construction industries, resource industries, and energy and transportation. The reported adjusted profit per share of $4.95 also handily beat the consensus estimate. The company's backlog, which is the future work it has lined up, reached an all-time high of nearly $40 billion. This is the core strength that underpins the bull case and pushed the stock higher. However, the margin story was a bit different. Adjusted operating margin was 17.5%, a notable contraction from the 20.0% seen in the year-ago quarter. Management attributed this pressure to elevated manufacturing costs, which included a clear and present headwind from higher tariffs. So while the demand is undeniably strong and the order book is historically robust, the profitability of executing that work is facing pressure. This tension, record demand versus squeezed margins, is the central conflict in the Caterpillar investment thesis. The core business model of Caterpillar is straightforward but complex in its scale and global reach. It operates through three main segments: construction industries, the iconic yellow equipment you see on every construction site; resource industries, massive equipment for mining and quarrying, essential for the production of everything from copper to iron ore; and energy and transportation, engines, turbines, and locomotives for power generation, oil and gas, and marine applications. It is truly a cyclical business tied to the beat of the global economy. Yet its vast global dealer network and high-margin aftermarket parts and services business provide a critical layer of stability and recurring revenue, which is a major long-term strategic focus for management. This services revenue stream is a counter-cyclical buffer and part of the reason the stock commands a premium multiple compared to some peers. Caterpillar isn't just selling a piece of iron, it's selling a decades-long relationship with a maintenance schedule and parts supply that keep the entire global industrial system humming. The company's financial arm, Cat Financial, further supports the business by providing financing solutions to its customers and dealers, effectively closing the loop on the entire sales process and adding another layer of recurring income. Now, as we shift into the future outlook, we must focus on the expectation versus reality around growth. The expectation, reinforced by the record backlog, is for sustained double-digit growth. However, the reality, as suggested by the cautious tone from some analysts following the Investor Day, is that the growth may be uneven. The AI data center build-out narrative, where Caterpillar supplies the massive power generation systems needed for these facilities, is a true accelerant. It's a high-multiple growth opportunity hiding in a low-multiple industrial stock, and it's a key factor driving up the stock's valuation premium, with the forward PE ratio currently sitting above the industry average. If this data center demand continues its current hockey stick trajectory, it could easily continue to justify the stock's current pricing, even with a broader manufacturing slowdown. On the flip side, the consensus is signaling a potential for softer demand in core segments, specifically construction industries, due to higher interest rates dampening project starts. This is the risk that has been magnified today. The market is weighing the spectacular but potentially short-cycle growth from the data center power boom against the classic long-cycle uncertainty in traditional construction. The company has raised its full-year revenue outlook, suggesting management has confidence, but the margin pressure from tariffs and inflation remains a key point of vulnerability. The industrial sector as a whole has enjoyed a strong earnings season, yet the macroeconomic picture is getting bumpier, and Caterpillar, being the ultimate barometer, is feeling that pressure. The ultimate catalyst will be the 2026 guidance, when investors will get a clearer picture of how much of the backlog converts to revenue and how persistent the data center demand truly is. We also need to keep a close watch on the resource industries segment, which is a bet on global mining capital expenditure. If commodity prices remain high and mining companies continue to spend on fleet replacement and expansion, this segment will be a massive tailwind. The risk here is a deeper-than-expected global economic slowdown, or a sharp, sudden decrease in commodity demand from key regions, which would slam the resource industries and immediately stress the valuation. For the average individual brokerage investor who manages their portfolio on platforms like Fidelity or Interactive Brokers, the recent surge in Caterpillar might make the valuation feel uncomfortable, prompting a review of their holdings, particularly if they utilize self-investing strategies. Those who rely on automated approaches, perhaps through a platform like Schwab Intelligent Portfolios, may find their risk profile shifting as the stock moves from a steady industrial play to a high growth at a premium stock. SoFi Invest in Robinhood users, who often skew towards shorter-term trades, will likely be focusing intently on whether today's technical sell-off is a brief dip or the start of a longer correction. Regardless of where you invest, this is a stock that requires attention to the subtle narrative shifts. The old belief that it's purely a construction stock is demonstrably incomplete. It's a diversified power and heavy equipment company with a growing and significant Tesla stock-like growth element, albeit a B2